Hey everyone, Sterling here from Day Trading Forex Live. It is April 26, 2012. We're going to be doing a little walk down memory lane this week with the free training this week. And the basis for this training was an email that we got, and essentially the question was, is this another strategy that is custom fit for a specific time? Is it something that is going to consistently work from from today onward, and is it going to work 3 or 4 or 5 years from now? And the way I answered that email was, well, we don't know what's going to happen in the future, but it's important to understand that this isn't our strategy, it isn't my strategy, it isn't Chad's strategy. It's a strategy that revolves around a basic market fundamental, and that is the largest liquidity driver in this market is the banks. That's not going to change. Because they drive the most amount of liquidity, they need supply when they are desiring to enter a position. That's called their demand. So in order to meet their supply, they need, or excuse me, in order to meet their demand, they need supply. That's a basic fundamental that's never going to change. And that really, although in and of itself is not enough to trade off of, that basic fundamental is what carries through and what makes the strategy uh, have worked, have worked in the past, years past, and more likely will consistently show the same thing years in the future. And again, it's important to understand that this isn't our strategy, it's the strategy that the banks use because they have to. And when we understand that, then we can start understanding how they're going to manipulate the market on a day to day basis. So let's get right into this. As you guys can tell, I'm a bit under the weather, but I wanted to get this out in response to the email. I think it's really useful for everybody. So again, we're taking a little trip down memory lane. Maybe some of you guys remember 2009, but we're looking back at some GDP numbers out of some UK GDP numbers, and what we're going to essentially show is the manipulation that generally comes out of uh, generally in the clearest sense comes out of the Asian accumulation, but in these specific examples, the way that smart money knows where the news is coming out, they have to induce the other side of the market. And so that's really what we're going to walk through here, walk through some examples a couple years back that show, essentially the same thing in the basic form what we look for today happening, almost 3 years ago. And I'm sure you could go back before that and find them all day long as well. So we're going to start with October 2009 as far as my 15-minute chart goes back on this specific platform, and so we'll start with that month. We look at October, and there was a decent positive deviation this month. That's the way it ended up working out. But what do we see them do before the market works to the downside? Again, excuse me, there was a decent negative deviation. If you go back and you're looking at the way this came out, if they know the news is coming out negative and they want to short the market, what do they have to do? They have to induce buying. How do they do that? Well, what is a good little retail trader going to do? They see this Asian accumulation, they see it start to break to the upside, they begin to buy. What do we have around any horizontal resistance point? We have those above that point that are getting stopped out of a short, therefore they have to buy it back. We also have those that are buying on the breakout. So in general, as they drive the market up, what are the indicators doing too? As the market is working down here, the indicators are rolling down. As it begins to pick back up, the indicators begin to roll back to the upside, begin to trigger longs. So as they drive the market up, they know they're going to induce retail buying. As they induce that retail buying, they're selling into the buying pressure. Absolutely shocking that they would do that. Being a bit sarcastic there. So we'll go on to the next month, and you're gonna have to pardon the sarcasm as we go through these next few examples here. We'll go to December. A nice example in December. Not much different. December 22nd. All right, let's go in here and let's zoom in a bit. We'll go into again December 22nd, 2009. And what do we see? Well, we see this Asian accumulation again, and it's absolutely shocking that they would come and take out the highs before driving the price down. It's no wonder that they knew GDP was going to be negative. You go back, you look at December, you had negative GDP. Before that news comes out, if we're going to see negative data, if they want to short the market, what's the best way to do that? You start trapping those London breakout traders. They're seeing it break above the last high, As they do that, you have those that are getting stopped out of a short position. They have to buy it back, as well as those buying on the breakout. Again, induce that buying. They sell into the buying pressure before what they know as negative news coming out. So let's move forward a bit to the next month. Again, by this time, as you scroll through these times, you start to see how consistently they will manipulate the market, and it also goes to show that in general they know the news before it comes out. Let's go to January 26th. And the reason I'm looking at UK data is because with US data, I think it's locked down a bit better. You see the manipulation after the news comes out more than before. So UK data, a lot of times you'll see the manipulation beforehand. Same thing here. Negative data. We'll zoom into January 26, 2010. I urge you to go look back, check these out for yourself. Again, negative data expected. So what do we see? This is before the London Open, and we see Europe open up. We see the market work to the upside, pull back a little bit, begin to work up again. What's that doing through there? It's again inducing retail buying as it works up, completes what we call a topping formation, and they have induced buying before they know the negative news is coming out. So smart money, what makes retail traders tend to lose with such consistency is the fact that in order for smart money to sell, the market has to be going. It doesn't. I overgeneralize, but in general, the market needs to be going up so they can sell into buying pressure. If they don't have buyers, they can't sell. You and I, we can sell. You can leverage our account to the hill and sell or buy, and there's always going to be liquidity for us. When 10 banks make up 50% of the liquidity or more, it's a little bit different for them. They have to induce buying pressure to sell into, and they have to induce selling pressure to buy into. Again, basic market fact here, and we're seeing that basic fact play out before the news because, again, they know which direction the news is coming out. In a $4 trillion a day market, do you think there's not a bit of corruption? And the fact that news is leaked or there's insider trading is something that shouldn't shock anybody, and it's really seen clearly through the charts. Let's say that uh, let's just say they're really good guessers, and you can you can take that for what you will. It doesn't matter the fact that even if they're extremely good at guessing with a high probability which direction the news is coming out, they manipulate the market against which way they know it is going to come out because they have to, in this case, induce buying if they want to sell into that buying pressure. We go to a more recent example here. Let's go back to actually a couple days ago. What do we see? Well, again, we had negative data. This is April 25th coming out here. And we talked about this one in the daily market review. I said, guys, you zoom out to your daily chart and you would have seen a high, sitting right roughly around the 65 level, I believe. And I said, it might have been 63, 64. I don't know, you have to go out to your daily chart, look at October. But we had a major daily high right at this point, one spot 61, 63. I said, if they're going to drive the market down, they're going to come take out these highs. What did they do before the negative data, very negative GDP? They come up, they take out those highs. Why do they take out those highs? Why do they induce buying before they know the negative data is coming out? It's because they want to get short. In order to get short, they have to induce buying. They come up here, they take out the stops, they trigger anybody buying on the breakout. Behind this, there was somewhat of what you'd term as a technical uptrend behind this, so people are expecting it to break out to the upside. You induce all that buying pressure, they immediately sell into the buying pressure, give the nice reverse legs back to the downside, and again, see the market sell off from that point. But the key there is that the manipulation precedes the move. They know which direction the news is coming out. It happens with extreme consistency. It happened years ago. It's going to happen years in advance because it revolves around a basic fundamental. They have to have buyers when they want to sell. They have to have sellers when they want to buy. And that's how we identify what they're doing on a daily basis. This just shows, some examples of news, which the basic fundamental can be used for trading news, but it's also that manipulation is identifiable on a daily basis, not just with the news. This just shows a good example of the fact that it's always been the same, it is the same, and it will be the same because smart money has to trade in a certain way. And that's, hopefully what this illustrates. So I want to pop over real quick to the pound yen. This is something that I currently have running at the moment. Let me zoom this down a bit. But this goes right with what we've been talking about. we're expecting some yen weakening data, essentially further easing out of the Bank of Japan, the BOJ. And what do we see them do before the market, is expected to rise? And I have a live trade going on this one. I'll update. I have a video going on it, so I'll probably be sending that one out a little bit later as well. But one thing we were talking about in the training room this morning is the fact that, okay, we're coming into a major overall low. Why would they drive the price down this aggressively before the news? Why would they drive the price down? What's the purpose of that? Again, if they want to buy the market and they know they're going to buy it and hold for an extended period of time, that's usually when you get your more aggressive moves against the ultimate direction they're going to drive it. And so what I was saying in the room is, we were looking at this about right around this time here, and I said if it comes back down and completes somewhat of a bottoming formation, that's where I'd be taking the entry. And a couple people got it. I'm personally long from 130.65, and it's something that I explain it a bit more in the video that'll be coming out again here in shortly. You can check that out as well. But it's no different than what we're just looking at with UK retail, or excuse me, UK GDP. It's no different. The principle remains the same. Before expected news, they're going to manipulate the market. That manipulation is key, and the different principles for identifying that manipulation are key as well. So we'll update this trade a bit more. I wanted to mention that one as well because it was a great example of the fact that before expected news, you're going to see manipulation against the overall move. And that's what we're looking for on a daily basis. We're looking to trade that manipulation because the manipulation generally is seen on a daily basis. So I hope this video was helpful, guys. I hope that before news you look for the stop runs. If you're not familiar with the stop run, I have videos on the stop run. I covered the stop run a couple years back. Did a video on the stop run. I need to update. I keep saying that. I'll probably update it soon. Go back, look for stop runs before news. Generally, if you see a tight accumulation area and you see a stop run above the high, the news is probably going to be negative. If you see a tight accumulation area, you see a stop run below the low, it means they're taking out stops low before they drive the market up. Now that's an overgeneralization. There's obviously more to it, but as an overgeneralized statement, that's something you can look for in your own trading, and I really hope that it serves you guys well in helping you avoid maybe some heartache on being on the wrong side of news, or just giving you a little bit more information and giving you a higher probability of which direction that news is more likely going to come out. So again, hope it was useful. If you want to check out more information, you can go to www.daytradingforexlive. We got a lot of free information on the site that as well I think would serve you guys well. So if you want to check that out, feel free and do that as well. Until next time, guys, happy trading.